All right, let's dive right into this. Welcome to today's Explainer, where we are digging into what is honestly one of the most fascinating corporate financial reports we've seen all year. Tencent just dropped its Q2 2026 earnings. And, at first glance, the numbers look like an absolute triumph. But if you scratch just beneath the surface, there is a massive mystery hiding in plain sight. We're looking at a wild paradox here. A tech giant that is generating mountains of cash, crushing revenue expectations and firing on all cylinders, yet somehow its profit completely missed the mark. So we've got to ask, where exactly is all that money going? Are we looking at a strategic masterstroke or just a massively expensive distraction? Let's get into the data and figure it out.
First things first, we have to talk about the headline number that really matters here, 204.8 billion won. To put that into perspective, we're talking roughly $30.36 billion generated in a single quarter. Tencent just completely blew past analysts' expectations, which were sitting around 202.2 billion, and they delivered a really impressive 11% year-over-year growth on their top line. For a company of this sheer, massive size to return to double-digit revenue growth, that's a huge achievement. Make no mistake, the cash is absolutely flowing in.
But here's where things get kind of weird. This is the central paradox of the entire earnings report. When we line up the top and bottom lines, we clearly see that fantastic 11% revenue growth. But the net profit? It grew by a microscopic 0.7% year-over-year, landing at 56 billion yuan. Wall Street analysts were expecting nearly 62 billion, so actually, Tencent missed its profit mark by almost 6 billion yuan. The top line is surging, but the bottom line is totally stagnant. To understand why that's happening, we first need to figure out if there's a leak in the ship somewhere. Is something wrong with Tencent's core businesses? Let's check out our first suspects.
Section 1. The engine. Gaming and ads deliver.
So, are the core businesses dragging down profit? The answer is a resounding no. The core engine is absolutely thriving. Domestic gaming was the superstar of the quarter, raking in 47.3 billion yuan. That's a 17% year-over-year jump that totally smashed expectations. International gaming brought in 18.6 billion yuan. And while that might look slightly down on paper because of currency fluctuations, it actually grew 4% on a constant currency basis. And then there's marketing services, which is basically their ad business. That segment surged 22% to hit 43.6 billion yuan. The core business is incredibly healthy. Just to ground those gaming numbers in reality for a second, because this double-digit return to growth wasn't just magic, it was driven by massive, undeniable hits. Over in the domestic market, they saw huge engagement from games like Delta Force, Valorant on both PC and mobile, Valorant Source Energy, and Roko Kingdom World. And internationally, titles like Withering Waves and Valorant really kept the momentum going, totally pushing through those currency headwinds we just talked about. Basically, the gaming division is doing exactly what it's supposed to do.
Now, that massive 22% surge in advertising we mentioned, that actually gives us our first real clue about where Tencent's focus is shifting. They've upgraded their smart ad platform, which they call AM+, and it uses AI-powered recommendation models that now cover over 80% of their clients. By deploying AI to squeeze more value out of every single ad impression inside the massive WeChat ecosystem, they are generating real, tangible revenue right now. It's a great reminder of how seamlessly AI is already shaping our everyday apps. But as successful as this specific AI integration is, it's honestly just a drop in the bucket compared to the broader strategy.
Section 2. The black hole, the massive AI price tag.
So let's pivot from the thriving core businesses to the real culprit behind those flat profits, the explosive, honestly eye-watering cost of building out the future. The crucial context here is expectations versus reality. Wall Street expected Tencent to spend about 32 billion yen on capital expenditure, or Capex, this quarter. Instead, Tencent spent a staggering 52.8 billion yen. That is a massive 176% increase year-over-year, and a 65% jump from just the previous quarter. So yeah, this is exactly where your missing 6 billion yen in profit went, and then some. It completely overshadowed anything the market was bracing for.
But what exactly is Tencent buying with 52.8 billion won? Well, in this context, Capex means hardcore, physical AI infrastructure. Actually, scratch the idea of them just buying software. They are pouring concrete and wiring steel. We're talking massive data centers, endless rows of server racks, and the immense, highly specialized computing power you need to train and run next-generation AI models. And of course, it takes top-tier talent to run all this hardware, which explains why the research and development expenses also jumped 35% to 27.3 billion yuan.
The sheer scale of the spending created some extreme financial friction in the short term. It actually drove their free cash flow to a negative 13.8 billion yuan. Let that sink in. Because of these massive prepayments for computing infrastructure, Tencent's free cash flow completely flipped for the quarter. Now, management was very quick to point out that, hey, if you just exclude these AI prepayments, free cash flow remained a very healthy positive 37.6 billion yuan. But you can't just wave away reality, right? Tencent is writing massive checks right now, and it is actively eating into their short-term cash.
Section 3. The market reaction. Wall Street pushes back. As you might guess, the immediate reaction from investors was not exactly a round of applause. On the day of the earnings release, Tencent's U.S. traded shares dropped by 4.3%. Over in Hong Kong, the stock fell nearly 2% to around 472 Hong Kong dollars. The market's message here was crystal clear. Wall Street absolutely loves revenue growth, for sure, but investors demand to know exactly what that growth is costing them today and precisely when it's going to pay off tomorrow.
And this drop? It's really part of a much broader context of deep investor anxiety. Tencent has already shed roughly $170 billion in market value this year alone. That leaves the stock trading about 19% below its estimated fair value. So why all the fear? Simply put, the AI race in China is incredibly fierce right now. Tencent isn't operating in a vacuum. They are going head-to-head with heavyweights like Alibaba and ByteDance, plus super aggressive challengers like DeepSeek. Investors are terrified that all this massive spending won't even guarantee a victory. It might just weigh down profit margins for years to come in a brutal price war.
Section 4. The long game. Management's defense. Tencent's leadership knows exactly what Wall Street is worried about, and they came to this earnings call armed with a very firm defense of their strategy. It starts right at the top. CEO Pony Ma stated that the company is making, quote, substantial progress towards building a new AI-empowered Tencent, end quote. What is absolutely crucial to understand here is that management is actively and knowingly sacrificing short-term profit. They aren't hiding it at all. They are deliberately choosing to build a proprietary world-class AI empire rather than just renting computing power from someone else for a quick buck. They firmly believe the very foundation of the company has to evolve.
So let's look at how this builds out practically. Management laid out a super clear sequential roadmap for deploying this expensive infrastructure directly into their consumer ecosystem. Step 1, they just launched Hai 3, which is the latest version of their proprietary Hunyuan AI model. Step 2, they are already out there testing Xiaowei, a native AI assistant living directly inside WeChat, getting it in front of hundreds of millions of users. And Step 3, they are already planning the release of an even larger, more powerful model called Hai 4. They are deploying this tech at lightning speed to lock down that crucial market leadership in China.
And just to reassure those nervous investors that this isn't some expensive science project, Chief Strategy Officer James Mitchell drew a hard line in the sand. He stated that top-tier models and leading applications will generate, quote, superior economic returns over the longer term. The strategy they're executing is crystal clear. Don't just rent out your compute power for pennies today, when you can use it to build a monopoly on AI applications that will literally print dollars tomorrow. It's a massive, but in their eyes, totally necessary long-term play.
Which really leaves us with the ultimate question of today's explainer. Tencent's core business is minting incredible amounts of cash, but they are burning through it at an unprecedented rate to build an AI fortress. They are fully committed to playing the long game in one of the most ruthless competitive markets on Earth. So, as we look ahead to the next few quarters, we all have to ask, will the long-term payoff actually justify this billion-dollar price tag? We are definitely going to be watching closely to find out. Thanks so much for joining me for this explainer. Keep learning, and I'll catch you next time.